are ETFs and what are the advantages of investing in ETFs and why do I need to know about ETFs? So many questions. It's the core of my investment thesis and the entirety of my toddler's investing. So over time, a great wealth builder. So let's sprinkle the facts, guys. The ETF stands for Exchange Traded Fund, and it's an investment product that is traded on exchange. Something we take for granted, but there is a lot of nuance and operational expertise that goes into allowing an investor to trade a collection of stocks in real time. An ETF always represents a collection of shares, which is called an index. Indices can be country specific even, such as the FTSE 100, the top 100-ish companies in the UK, the S&P 500, the top 500 stocks in the US, or the NASDAQ. ETFs can also be the whole world, covering a number of major market indices, or they can just be a sector or industry specific, covering a smaller segment of the market even. So I'll pop in a snazzy diagram here of how ETFs are born, as you can see. So there are some essential points to understand. An index of shares is not a basket of shares that is bought directly. Instead, an index is like a recipe card telling us and the ETF providers what stocks and how much of each stock make up an index. So in the case of the FTSE 100 ETF, the ETF provider is not buying the FTSE 100, but buying the individual shares in the FTSE 100 according to their weighting in the index. It's all a little bit technical, I'm not gonna lie. So let's jump into why they are so advantageous for us investors. Firstly, automatic diversification. This is something I talked about in a recent video with Warren Buffett, explaining that for the vast majority of investors, keeping it simple and buying a diversified ETF is the best thing. What does that mean though? Well, as we have noted, ETFs are a collection of stocks. Thus, when you buy an ETF, you are invested in several shares at once. So you're reducing your risk and your costs. Magic. But how does it reduce cost? Well, investing in an ETF allows us to invest in several stocks in one transaction, and that's the key thing. For a FTSE 100 ETF, one transaction to buy an ETF triggers 100 actions below it. So, you own shares in 100 companies for the execution cost of one trade. And that's so lovely. It's like buying a multi-pack. So instead of buying one Coke, you just buy the 24 can stack. And there you go, one transaction instead of buying it 24 times. That being said though, just because you own several shares at once does not mean you are safe or your investments are protected. You're now exposed to the market, and that could be as diverse as the entire world, local to the UK if you choose the FTSE 100, or even more local, such as buying an ETF which provides exposure, just say, to the banking sector or the pharma sector. The more niche and directed the ETF, the greater the market risk an investor takes on. You can visualize that quite easily, right? So overall though, an ETF is considered to be a safer and cheaper way to invest. Second of all, an ETF provides precise investment returns by picking factors. This builds on the last point, which is you can use an ETF to identify and invest a specific returns factor. In this instance, a factor is the determinant of where your investment actually comes from. So for instance, you may take a view that smaller companies have a better or worse chance of success with the current economic climate, COVID and all that jazz. Having an arbitrary view like this can mean you can enhance or eliminate this factor. So for instance, if you believe small caps won't do so well with the pandemic, then you can invest in large caps. And if on the other hand, you feel that they could do well, then you can invest in a small cap ETF. It's all fun and games really. Now, this is stating the obvious when we talk about major market indices and corresponding ETFs. However, factors can become kind of interesting where an investor wants to take on more risk from emerging markets or small caps, which have the prospect of bigger returns but also higher volatility. Using the recipe card example of an index again, a normal global ETF would have more exposure to the largest global economies of the world and the largest companies in the world. And understanding factor investing allows an investor to change that around and take on more exposure easily from those emerging markets. The beauty of this is you can invest in a factor at low cost and not knowing the full details behind it, and it can form a macro view of the sector, country, or region even. The third thing we'll talk about is automatic reinvesting. So some companies distribute a profit sharing bonus as dividends, and so you can buy ETFs in two forms. So there's the distributing ETFs, and these pass on the dividends to the investors directly, and the accumulating ETFs, and so these dividends are used to buy more shares and reinvest it directly. Now these both types are super cool, and indeed you can buy an ETF where the specific purpose is to generate higher yields. The dividends are either directly or indirectly paid to investors. However, accumulating ETFs are, in my opinion, a lot more cooler, because as dividends distributions are directly reinvested without the investor having to worry about it. So that avoids transaction costs, so no more fees, and any lag in participating in the ETF exposure. So there will be no FOMO, as they say. The fourth point I want to make is saving plans. So with many of the large providers, there is an option to automate investing each month by setting up a direct debit. It's simple and pretty straightforward and gets your money invested. It's as simple as that. So 2020 was a difficult year in the real world, but markets have been resilient, guys, with certain sectors picking up where others perhaps declined. Buying a fixed amount each month through a savings plan, you'll automatically buy more shares when times are hard and less when times are good. And that flows into the concept of dollar or pound cost averaging. And despite 2020 being a bad year in the world, as an investor, you would have made a nice, healthy return. But check out my video for an example on that itself. Last and final thing I'll talk about is investing bias. The shares we all know about is limited. It's a drop in a vast ocean of stocks, really. This is an important point to think about. A great book on this topic alone is Investing Demystified by Lars Kroijer, where he shows that investors tend to overinvest and expose themselves to their home countries, thus increasing risk. But being exposed to your home country or your home sector means you are heavily vested in one outcome. So take the UK, for example. The Brexit uncertainty had dampened the FTSE 100 performance, where the rest of Europe had been up and the US soaring. And as a retail investor, we should seek to eliminate these biases to maximize our chances of consistent returns. Final point is performance. So most important is, of course, performance, and not just the performance with market growth, but also performance versus active stock pickers. ETFs have shown time and time again that they will generate higher returns than portfolios of individuals or stock pickers. The main drivers for this are the higher costs. So individual stock pickers incur more frequent trading costs because they try to time the market. On the whole, no one can really predict the market, and timing the market is better than timing the market, guys. My dollar cost, pound cost averaging video shows that how crazy that was for 2020. Factor investing. If you have a market view, you can execute it with little cost. So for instance, knowing the shambles that Brexit would be, we could have invested in European and global ETFs that exclude the UK, thereby enhancing your returns. So here we have covered some of the advantages of ETFs, and my dollar pound cost averaging video goes really well with this video, and that demonstrates why it doesn't matter when you invest but how you invest. So here are those videos to cover those, and I'll see you over there.